very good evening and warm welcome to our valued investors. I'm Ghazal Jain, Associate Fund Manager, Alternative Investments, and in today's exclusive webinar, I'm in conversation with Mr. Chirag Mehta, Senior Fund Manager, Alternative Investments, as we discuss why gold's recent volatility is in fact an opportunity. Gold prices have corrected by about 8% over the last 2 months, and investors are naturally concerned. So in today's presentation, we will dive into why we think this is a temporary correction, why gold's prospects over the next few years are bright, and why gold is imperative from a strategic point of view. So without further ado, let's get started. We would encourage you to send across your questions using the chat option on your screen. We will be taking these questions at the end of the presentation. So let's get started. Over to you, Chirag.
Thank you, Ghazal, and thank you everyone for logging in. We will share our views on gold, why we think what's driving gold, and what are the trends that we are seeing in the gold markets. And before we begin, I hope everyone is safe and doing well. We'll run through a few slides, and as Ghazal said, please post in your questions, and we'll be happy to answer them. So what's happening in the gold market? So if you see prices have corrected by 8 to 10% in dollar terms and rupee terms. We've seen some corrections since August. Financial markets or equity markets, if you see, are buoyant, are moving higher. Some unlocked trade, some optimism playing in those markets. Naturally, there is a slowdown in flows that are in gold right now. Only that's in consumption markets, but if you see the investment markets are still booming. So overall, it's if you see the trend since 2019, even before COVID, we had seen a run up in gold prices, and post COVID, it just accelerated, barring the fall that we saw in March because of people trying to raise money for liquidity needs. And thereafter, it's been taken off. It had taken off nearly to $2,000 and above, and from there, we have seen some correction, a small dip. So is this concerning? Are we seeing some change in trends, or is this alarming for investors? What should investors do? Those are the things that we'll try and answer today. So let's rewind back to the previous bull market that we saw in gold from 2009 to 2011, which was it was actually the bull market started in 2001-2, but the main rally came in after the global financial crisis hit in 2008. So if you see post that how markets had trended, there were various corrections. So if you see, there were about 6 corrections which are more than 7%, right? So you usually had those dips of 7, 9, 10%, and occasionally the small dips or the movements that we see in gold prices. It's not a straight line. It kind of wobbles around 3 to 4% and then maintains that trend. So that is what we saw last time, right? Before, in that period, we saw a total gain of more than 100%, and it was not a straight line. It was up and down movements, right? Even this bull market that we are seeing in gold, which started in 2018, end of 2018, continued through 2019, and then after the COVID push, if you see, from less than $1,500 an ounce, it just rallied to about 2,100 kind of levels, and we are seeing a small dip now. Even along this way, even in March after COVID hit us, there was a correction of 12%, and this is about 8% correction. So corrections are a characteristics of a bull market. Nothing can go up in a straight line. What matters is what are the fundamental factors driving it? Are that positive for that asset class or not, right? So many are worried about US elections, what's going to happen. So there's too much noise around who will win, whether it will be Trump or Biden, what's going to happen. So if you see, just to analyze what are the policies, broad policies that Trump or Biden will pursue. Trump, higher spending, stimulus may be smaller, but if you see the spending that they generally do, that it's kind of a very high deficits. Even in 2019, which is a good year for the economy was still growing. They had a deficit spending of $1 trillion, right? The major reason of that is not higher spending, is because lower taxes. And once government has lower revenues, it kind of leads them to borrow more money. So that is how Trump has been, and there will be volatility in markets. I mean, there will be a lot of chaos because the kind of policies that he pursues, like the U.S.-China tensions or trade war, as it is famously known, it is going to be part and parcel of a Trump administration, right? So there will be deficits, there will be chaos in terms of his policies, his America First agenda, all that. Uh, when it comes to Biden, which is kind of leading in the polls, even the betting markets are saying that Biden is going to be in power. Uh, Biden's policies, if you see, he believes in higher taxes for the rich or the corporates and higher spending. He will kind of spend more and also try to collect more taxes. But that collection of taxes may kind of trail. So in the initial years, his spending will lead to a lot of deficit for the government. Government doesn't have money. The economy needs a lot of money in form of stimulus. So overall, there will be a lot higher spending, lot of deficits, and again, his policies are not going to be positive for the U.S.-China relations, but it's not going to be as aggressive as you see in Trump. The third outcome is also going to be could be a contested election, like Trump has been vocal about it, right? If you see, he said that if he loses, he may not hand over easily to Biden. He may contest that it is kind of rigged. So there will be political uncertainty. There will be weaker dollar if that happens, which is also kind of a probability which can become true because the Biden is leading in the polls, and if he wins, Trump may act, right? So overall, in a clean Trump victory, Biden victory, we can be sure that there will be, at least over next 2 to 5 years, there will be larger deficits, right? So we'll come to why deficits matter, because it weakens the dollar and it helps gold. So we'll come to those slides and see those long-term charts. Uh, uh, there is a lot of I mean, people are worried that Indians, which are larger consumers of gold, China, which is a large consumer of gold, is not consuming as much as it did before. But always remember, investment is the biggest driver for gold. Whenever you see bull markets in gold, it's the investment demand that drives that. So this year, if you see, the gold ETF demand has crossed 1,000 tons. So overall, this has been the largest we have seen over last 20 years, right? So investment demand is booming, and that is why we are seeing gold prices higher. India, people are worried that India is not consuming much, but if in the biggest driver for gold consumption in India is marriages, right? We have about 10 million marriages a year. So if those marriages are not taking place, people will not buy it now. People will kind of postpone their purchases whenever that event comes. So has the consumption gone down? I don't think so. It's just been postponed. It's kind of compulsive buying that happens from India. And that compulsive buying is about 600 tons a year. Rest is gifting, investment, and those kind of demand that we see, which is about 200, 300 tons of gold. So overall, Indian consumption, Chinese consumption is only got delayed, but it will come over a period of time. But investment demand continues to be really strong. Uh, we kind of put it in a subtle way that there are 5 reasons why gold seems to be headed higher, right? Uh, these we'll go one by one on each of them. One is the accommodative central bank policies, the way central banks are pumping in money. Second is dollars is going to decline going forward, is going to weaken going forward. Third is we will see higher inflation. We'll come to reasons why we will see higher inflation. Number 4 is the rupee kind of depreciates. And fifth, very important, is gold, despite all the buying that we have seen, is still under-owned as compared to the overall allocation of people. So accommodative central banks. First, to give a backdrop, COVID-19 is far from over, right? Everyone was saying that cases in US and Europe have started declining, and therefore COVID has reached its peak. And just people were kind of assuming that we saw a second wave in US and Europe. So number of cases have been increasing. These economies like Europe, UK, are kind of going through their versions of lockdowns. So it does restrict activity and overall impacts growth. So overall, it's going to be still a challenge on how we overcome the COVID crisis. If you see, Trump and his family were latest infected in terms of the world leaders. So it's kind of spreading across the globe. Uh, People say whenever there will be vaccine, uh, it's kind of game over for gold. I don't think so, right? If you see, this crisis is far more severe than any other crisis that we have seen over the last 100 years. You'll see those charts why it's worse than what we have ever seen. Uh, but firstly, vaccine is still some time, at least to mass rollout, and therefore till that time the policies will have to be accommodative from central banks. And not only that, if you see the 2008 crisis, which was just a financial crisis, the US central bank, US Federal Reserve, had to keep rates lower for 6 years together after that, right? And this is not just financial crisis, it's an economic crisis, right? And therefore the economy needs far longer support than what it would have otherwise. And the policies from these central banks, from the governments, will have to remain supportive for a very long time and have to be aggressive over next 1-2 years, right? Look at the stimulus we talked about in the US. They've already done trillions of dollars in stimulus. They're talking about another $2 to $3 trillion in stimulus. So it's not. I mean, the economy is really in doldrums in the US and Europe. So it will need support from the governments. So people are talking about a V-shaped recovery next year. This year is a kind of a washout. Every economy is kind of going through a very bad recession, and this is very severe. If you see, the number of countries in recession is over 90% of countries in recession in 2020. And if you see when this was, anytime close, we have to go back 100 years almost, in 1930s depression. That was the time when we had so many countries, or nearly about similar countries, in recession. So it's come after a very long time. We haven't seen how this is going to shape up. Uh, uh, People are talking about a V-shaped recovery. We don't know if it's going to be V-shaped or it's going to be a K-shaped. We had told in previous webinars that initially any rebound that we see in economy will look like V-shaped, because the extent of damage was so severe. Even small normalization, even a very small coming back to the world will look like a V-shape, but it need not be V-shaped. This crisis will take longer for economies to come back to pre-COVID levels, right? We come back to the growth levels that we were seeing earlier, right? So if you see, global economy is kind of reversing decline. What we saw about the rebounds, which will look like V-shape, but is this V-shape? Look at the relative strength of these economies as an indicator. So if you see, the emerging markets have not even kind of pulled back anywhere close to pre-COVID levels. Even the advanced economies are nowhere close to the pre-COVID levels, right? The confidence amongst masses, amongst businesses, amongst households is still very low. And it's again nowhere close to the pre-COVID levels, right? So people will take time to kind of consume the way they used to, kind of have a confidence in their income streams. So this is going to take some time. US unemployment, everyone shows that it went to 15%, is now around 8% levels. So we are seeing people come back into the job market. But if you see, one thing that changes, if you see the right hand side of the chart, it's the labor force participation. How many people are actively looking for jobs? So how do you find the unemployment level? Is how many people out of job, and what is the denominator is the labor force participation. So labor force participation is still 2 percentage points lower. So what it shows here on the chart, at 8% unemployment level, actually it is higher than 10% unemployment level, because of this adjustment on the labor force participation. The denominator has changed, right? People are not finding jobs, they've stopped looking for it. This is what the right hand side chart shows. So overall unemployment is not, it's improved from the lows that we have seen, but it's still very far from the pre-COVID levels. Pre-COVID was around 3%. We are still at 8%, and if you adjust for this, we are at 10%. So we still have a long way to go as far as the US unemployment is concerned. Why we said it will going to take a longer time for the economy to come back on its feet. Even the World Bank chief said that it will take as much as 5 years for economy to see a full recovery, right? If you see the extent of damage in the job market in the US, nearly that much time it takes for the economy to come back. So if you see the orange bar on the 2020, it is showing you the extent of damage that we have seen, and anywhere before it had never been so bad, right? Like the 2008 crisis, the number of jobs lost was nearly half of what we have seen in 2020, and it took 6 years for the economy to come back to full recovery, right? So if you have taken the double the time, it could be at least as much time that it took in 2008. So at least it will take, we kind of reconcile with the World Bank chief economist. It will take 5-6 years on the minimum for the economy to see a full recovery. Uh, Interest rates are an important driver for almost everything in the economy, right? Uh, so if you see, before even the COVID crisis, central banks were cutting rates, right? And that is why if you see our yearly outlook, we were positive for gold even before COVID. Even in our January outlook that we gave for the year, we were kind of bullish on gold, right? This is one important driver that made us bullish. So if you see rates are falling, are at zero. Post the 2008 crisis, it stayed there for 6 years. This time also, it will stay at this level for a fairly long time. The negative yielding debt, this was unimaginable a few years back, right? Uh, can you imagine any country's bonds having a yield which is negative? This was unimaginable. Anyone who has studied economics would have never come across this before, but this is a reality today. And it's not small. It's nearly 25% of all bonds, like about 14 to 15 trillion dollars of debt is yielding negative today. So meaning if you're a holder of those bonds and if you hold it at maturity, you will lose money on that. That's something that is kind of difficult to reconcile. And if you see the way it increases, the gold prices are also inched higher, right? Because if you're a holder of these fixed income instruments, you said negative yield doesn't make sense. Why should I invest in that? Instead of I go to something that will preserve my purchasing power, and that is gold, right? So overall, there is a very high correlation, or the biggest driver of gold, if you could say, is real interest rates. What is real interest rates? It is interest rates minus inflation. So if your interest rates are not enough to cover the inflation going in the economy, then you're yielding negative, right? So it was, if even in the 1970s, we saw negative real interest rates. That time we saw a big rally in gold, right? Even in 2008 crisis, we saw negative interest rate, real interest rates. We saw a big rally in gold. And even now we are seeing negative interest rates, which will kind of remain negative for a fairly long time because rates are not increasing. So overall, we think this is one of the biggest factors driving gold, and it will continue to drive gold for next few years. Second, central banks are printing a lot of money. They are pushing in a lot of liquidity, trying to support financial markets, trying to support the economy, trying to buy assets which no one else is buying. So that's all the central banks across the globe: US, Japan, Europe, China. Everyone is pushing in a lot of liquidity, and maximum by the US. US is leading this effort, right? And if you see at the fag end of the curve, US is kind of plateaued, right? The US printing of money has kind of subsided for now, because there is a limit to which the central bank can do in terms of helping the economy. Somewhere along the line, it has to get that monetary stimulus from the government, right? So this plateauing is also reflected in gold markets, right? This not going higher now is kind of also led to a pause in the gold rally that we have seen. But we anticipate this QE, the quantitative easing as it is called, the money printing by central banks, will continue going forward as well. So so the what are the pause we are seeing is going to continue, and gold will kind of rally with it. So these central banks are making it possible in terms of the governments are issuing debt, and these central banks are printing money and buying that debt from the government, right? And these central banks have become big in size, right? Their balance sheets of the largest four central banks as percentage of GDP is now 50% of the GDP. Before COVID crisis, it was at 35%. After this, the printing of money that we have seen, it has increased to 53%. There is also one help that the central bank printing of money does. Like blue line is the Federal Reserve's balance sheet. The amount of money they keep printing, the balance sheet increases, and this is how the balance sheet has grown from less than $1 trillion in 2008 to about $7 trillion now, right? So they are kind of playing in trillions now. And if you see, that has clearly been a support for financial markets, right? The red line is the US stock market. The way the balance sheet of this central bank has grown, the stock market has grown along with it. So this says that this central bank printing money is kind of bringing the complacency in financial markets. Like you don't fight the central bank kind of thing, right? Wherever they are flowing their money, be there. That's not a very good thing. That may not continue forever, right? So if you were to summarize this, the low negative interest rates continue making gold attractive. That is what is driving people in those developed markets to assets like gold. That is why we are seeing the gold ETF assets there increasing significantly. Central banks are printing a lot of money. Again, that leads to currency debasement, that loses the value of the currency because they are printing so much. And therefore, that's bullish for gold, because gold at the end of the day is a monetary asset, right? And there is a complacency in stock markets globally, and it's driven by this pumping of money by central banks. If there is a big correction in stock markets for any reason, that will again drive people towards assets like gold. So number two reason is dollar is gonna decline, is gonna weaken going forward. We already seen some weakness after the COVID crisis. We think that it will further decline. So if you see the debt levels across the globe, be developed nations or emerging markets, more so in the developed economies, have grown significantly. US debt to GDP ratio stands at more than 100%. So these central banks have been, the governments are continuously issuing more debt, and this is not a sustainable thing going forward. Why? We will tell you. This chart tells us all. If you see, the red line is the debt of US, and the blue line is the GDP of US. So if you see post 1970, you will see both line kind of, before that, both line moving in tandem, and there is a widening gap between the two from after 1970. Why this is crucial? Because after 1971, the US government delinked currency from gold, right? Earlier, it was the currency of the US dollar was backed by gold. After 1970, it was not backed by gold. So it gave central banks the leeway to print more and more currency. And as they do that, they require more and more debt to be created for to generate that incremental GDP. So this system is not going to be sustainable. There will be cracks sooner or rather than later. And that is the time when gold will see a revaluation. Uh, People talking about US stimulus, there is a kind of a debate because it's all political, right? And that is driving or delaying the stimulus that would have come from the US government, right? So we think that economy still needs a lot of support from the government. The monetary policy has reached its limit in terms of stimulating the economy. It is going to be the government stimulus that will drive or help the economy going forward to come back on its feet. So overall, we are seeing signs of slowing. So stimulus will come very soon in the US. It's not derailed, it's only delayed. So as they come out with more stimulus, it will further debase the dollar. It will further weaken the dollar. Uh, if you see, the US is kind of continuing to run deficits since 1980s. If you see, there was a small tad period before the 2000s where they kind of came back into surplus, but otherwise the government is continually running deficits, and deficits lead to buildup of debt, right? Because to fund these deficits, they kind of issue more debt. And if you see, the deficit this year is kind of gone through the roof. We're already at $3 trillion deficit, and there is more stimulus coming, which will again increase this increase this deficit going forward. So overall, uh, even in good years, as I said, they were running $1 trillion deficit, right? So it's kind of an habit now. The economy is kind of habituated to borrow more and increase government spending. If you see the debt this year has gone off to about 135% of GDP. One beyond 90% is usually the tipping point where the economy debt becomes so big that it starts impacting the growth in the economy. So it will happen in the US, and we have been seeing that. If you see the growth rates in the US, it used to be a couple of decades back, it used to be like 6% growth. Then we came to a normalized growth rate of 4%. Now I think the debt level has grown so much that it will further slower growth. So I'll not be surprised if the US economy kind of starts growing at 2.5% kind of growth rates on a normalized basis, right? And as they print more currency, as they print more dollars and push it in the system, the gold that they hold is still constant. They're not buying gold further. So gold per currency of circulation is kind of declining. They had 141 tons earlier. Today they have only 4.5 tons. So they have debased their currency vis-a-vis gold. And we have seen that most of the currencies that have acted as reserve currency, like US dollar is acting today, that has been around 100 years, they have lasted as a reserve currency. In 2020, the US dollar completes 100 years of being a reserve currency. So there have been some challenges. There have been some signs. The policies that the US government is running, the world is not comfortable with it. So US dollar could kind of, if you get a replacement, could kind of cease being a US a reserve currency going forward. Central banks have been buying a lot of gold over last many years. I think this trend of diversification of their reserves is going to continue going forward. Central banks are kind of moving out of US treasuries. They are buying lesser and lesser of US paper and buying a lot of gold. So this is a trend that we are seeing in shape up over last few years. And I think this is going to continue going forward. So overall, U.S. policy making is not really sustainable. They are continuously issuing running more deficits and issuing more debt. So that kind of puts the U.S. dominance under threat. Central banks will kind of continue to move away from U.S. treasuries into assets like gold, diversify into that. So overall, this kind of makes us the dollar weakness and central bank moving out of the dollar is kind of positive for gold. Higher inflation is kind of going, people kind of question me that even in 2000, after 2000 crisis, the central banks printed a lot of money, but there was no inflation that we did see. Remember 2008 crisis was a financial crisis, right? And the money remained within the financial system, right? Amongst the financial institutions, because financial institutions are bailed out by the money that the central bank printed. This time is different. This time is an economic crisis. The economy needs support. If you see even the last stimulus, there were a lot of programs from the US which gave handouts to people. People were sent checks directly. So money is going down, not remaining in the financial system only, going down to the real economy. It's trickling down. So as they create more money and as it trickles down, it's landing. It's landing in people's hands. And therefore, as people go out and spend, this is going to be inflationary, right? As opposed to the 2008 crisis. So we have seen as whenever the fiscal monetary policy runs its course, we have seen the fiscal policy kind of comes into action. And fiscal policy will only come into action when the government borrows more and spends more. So they will kind of run more deficits, like we have seen in 1940s. If you see those big bars on the left hand side of the chart, uh, that was deficits run by the US government. And that then was the advent of inflation that we saw after that. So even this time, I think the monetary policy has run its course. If the economy has to come out of doldrums, it will need a lot of support from the government in the form of stimulus. And government doesn't have money. They will have to kind of borrow and spend. And therefore, this time, when they do that, money will trickle down to the real economy, and it's going to be inflationary. Number four reason is long-term rupee depreciation. We have seen rupee depreciated, or if you see from 1970s till today, rupee has depreciated by 5% per annum. And one can debate if it's going to be 3, 4, 5%, but we think structurally rupee is kind of going to depreciate. And if you see, most of the times it comes in a very sharp depreciations. Rupee then consolidates, and then we see a sharp depreciation. That's been the trend. So we think that rupee is kind of going to depreciate. So any rupee depreciation that we see, be it of 3, 4, 5% per annum, is adding to the gold price return, right? Number five, very important reason, gold is still very under-owned asset. If you see the bond market in the US, or is kind of roughly about 12 to 15 trillion dollars in that range. Even a small shift, because people don't want to see erosion of wealth. People are in fixed income instrument because it protects wealth, but if it yields you negative return, meaning you have to pay the government or the entity from whom you're buying debt to kind of buy that paper, you have to give money back. That's a negative return for you, and people don't want that. People want something that can at least preserve their purchasing power, and therefore there could be a big shift. And if even if there is a small shift of 1-2% of that investments in the bond market, that's going to be significantly large money for the gold market. So overall, if you see the gold allocation, if you were to see what kind of allocation people have now vis-a-vis the all ETFs that they own in the US, because people mostly buy everything in the US in form of ETFs today, right? So that's a good barometer. So gold ETFs as a percentage of all ETFs is around 3% now. If you go back in history, before the 2000 crisis, it was around that same 2% level. It went up to 8% level. Then as people redeemed out of gold ETF to some extent and invested a lot more in other equity ETFs, the share of gold came down, and it's now again inching higher. So I think this will again kind of probably move back to that 8% level that we saw. So there could be a lot of investments flowing into gold ETFs in the US. From a portfolio perspective, you see entire global wealth, and gold as a percentage of that wealth is still about 2.5%. People generally talk about allocation to gold be at least 5%, 10%, 15%. We ideally think it has to be between 5 and 10, 15%. But if it were even to go to 5%, it's kind of doubling what people own today in gold. So there is bigger scope. We are seeing that trend unfold, and this could lead to a significant amount of buying in gold. So overall, gold remains an under-owned asset. There is good potential for large buying to come for gold, and if it does, it will lead to much higher prices. So overall, these are the five reasons we think that gold probably is headed higher. This is the long-term chart of gold. Some may think that is this a bull opportunity or is this a bear trap, right? Is gold peaked or is it still further to run? We think the factors are clearly positive for gold. If you compare this with the previous bull markets that we have seen, previous bull markets, gold has seen usually about 400, 500% kind of returns. And currently we not even have crossed are just about that 100% mark. If you see the lows that we have seen to the peak that we just saw, is just close to that 100% mark. So if previous bull markets have grown to 400, 500%, factors are still positive. We don't know where it's going to go, but in comparison to previous bull markets, there is further room for gold to go higher. So where could gold prices go is a factor of where the dollar gold prices will go and where the rupee will go. So if the we are at 1900 today and rupee is around 73. So if rupee depreciates like it has done in past years, if it goes to say 75, 81, 84, those kind of levels, and rupee and the dollar gold price will kind of inch higher, maybe 2000, 2200, 2400. It depends where it goes over next few years. Will depend where the gold, for example, if the rupee were headed to 84 on the dollar, and if the dollar gold price goes to 2400 an ounce, the gold prices will inch very close to that 75,000 mark. So over next few years, depending on how factors unfold, it will depend where the gold prices will land up. Uh, so, uh, so the factors look constructive for gold. The long, it's positive for gold. But whatever I have said is just the icing on the cake. The main reason why you need to have gold in your portfolio is very different, because it kind of helps your portfolio in a big way. And I will request my colleague Ghazal to take you through those reasons. Thank you so much.
Thank you, Chirag. So gold has given spectacular returns over the last 1 year, and this has obviously led to an increased investor interest in the asset class. And that's great, especially since Chirag has just shared with us, the tremendous potential gold has going forward. But in the midst of all this action and excitement surrounding gold, I want to try and make a strategic case for holding gold in your portfolio to the tune of 10 to 15% at all times, no matter where prices are headed. So let's get started. Next slide, please. Thanks. Uh, so to start with, we have mapped out asset class returns over the last 15 years. So this chart ranks the best to worst performing indexes per calendar year from top to bottom. So as you can see, there have been years when equities, did brilliantly, years when bonds were really dependable, and some years when gold shined the brightest. So what this clearly means is that asset classes go through ups and downs, they go through cycles of pessimism and optimism, and there is no way to consistently predict these cycles. So for example, like we've highlighted, if an investor had an all equity portfolio in 2008, and he would have lost about half of his portfolio that year, very painful indeed. And then having burnt his hands in the stock market, if he had exited equities that year, he would have missed out on the stellar returns that came about next year. So essentially, to reduce the impact of a loss-making asset on your portfolio, or to reduce the dependence on a single asset class, it is prudent to stay invested across asset classes. Next slide, please. So with this context, let's zoom in on gold and equities now. So if you see, over the last decade or so, gold, because of its low correlation to equities, did well in 2008, 2011, 2016, and now in 2020. These were the years when equities took a hit. So because of its low correlation to equities, when the stock market suffered, gold could have limited your overall losses. Proving that it is really an effective portfolio diversifier. So to get a deeper understanding about this portfolio diversification characteristic of gold, we did a risk return analysis of how different portfolios would have performed over the years from 2004 to now. So you can see the equity debt gold portfolio with ratios of 40, 40, 20 has done only marginally lower, has done only lesser marginally compared to an all equity portfolio over the years. So compared to an 11.5% returns of the equity portfolio, this diversified portfolio has given about 10.4% returns. Also, in addition, this diversified portfolio has effectively reduced risk for the portfolio. So you can see that the annualized standard deviation is just half of the annualized standard deviation of a pure equity portfolio. Similarly, the maximum drawdown of a diversified portfolio in, in one of like the market crashes would have just been about minus 21% compared to minus 56% if you owned an all equity portfolio. So again, owning gold is not just about the upside potential. You have to see that the diversification benefit it brings to your portfolio. Gold is about diversification of the downside risk. Now that we are sure about gold's role as a portfolio diversifier, let's move on to its role of being an inflation hedge. So, with the unprecedented monetary easing that we're seeing world over, along with fiscal stimulus and the supply disruptions that have been triggered by the pandemic, it is fair to expect that higher inflation is coming over the next few years. So, in that case, gold can be a good investment pick, as you can see in this chart. So here what we've done is we have tracked the inflation of a consumer basket over a 30-year period from 1990 to now. So now it is a well-known fact that equities grow faster than inflation and can effectively cover increased cost of living. So here if you see the BSE Sensex, which is representative of index of equities, has given an annual return of about 14%. This is much higher than the inflation of the consumer basket over this time period, which is at 10%. But what is often missed is the fact that gold too appreciates in line with inflation and conserves purchasing power over the long term. So if you see, gold over this time period has given a return of 9.5%, which is almost at par with inflation. Now let's focus on the part that is highlighted in yellow. Fixed deposits, Indian investors' preferred investment avenue, over the same time has just given 5.8% annual return, which is grossly inadequate when compared to inflation. So in real terms, an investor holding a fixed deposit over this period has actually gotten poorer because now his money buys him lesser or fewer goods. So continuing the discussion on inflation and fixed deposits, we can see that inflation in India has been inching up over the last few months. Retail inflation for September has come in at 7.34%. And at the same time, interest rate cuts are being implemented by RBI and the banking system to help the battered economy. So what we're seeing is inflation going up and interest rates going down. So what this effectively means for fixed deposit, bank fixed deposit investors is that they're going to be earning negative interest rates for the foreseeable future. So in such a low interest rate scenario, gold can be a good addition to the portfolio to compensate for lower fixed deposit returns. So this is another reason or more reason for you to diversify into gold. So in summary, gold is more than just a tactical allocation. It is a strategic portfolio asset. It plays the role of a portfolio diversifier and preserves purchasing power over the long term. That's why at Quantum, we have always recommended that our investors have an allocation of 10 to 15% to the metal at all times. Now that we've established that gold is a portfolio imperative, let's understand the features and benefits of various gold investment avenues. We'll obviously start with physical gold coins and gold bars. This is the most preferred investment avenue. And this is actually a good avenue if you are buying gold coins and bars for personal consumption, for jewelry, for gifting. But as an investment avenue, there are a lot of drawbacks. Firstly, the wholesale and retail markups that the jewelers charge you increases the cost of acquisition and eats into the investor's returns. Secondly, purity is always a concern. You can never be sure that the gold you're paying for is 24 karat gold or 22 karat gold as is being claimed. I can say this because several surveys that have been conducted by the Bureau of Indian Standards has established and concluded that purity of physical gold is a concern in India, and smuggling of gold too is very rampant. So purity is always a concern when you're going through the physical route. And lastly, at the time of selling, investors generally have to sell the physical gold at a discount, which again impacts their returns adversely. So next slide. The other avenue to invest in gold is gold stocks. Basically, these are gold mining companies that you invest in. But they are stocks first and gold second, and they tend to move in line with equities, and hence they beat the purpose of investing in gold, which is to diversify against equity market risk and equity volatility. So this is not something that investors should prefer. Please. Gold futures contract. These are highly complex instruments, not something retail investors can easily understand and get used to and use. They also have higher risk, and they're more suitable for short-term trading, not for investing purposes. Next avenue is, of course, the sovereign gold bonds. These have been gaining popularity recently. So what these bonds do is essentially they give you exposure to gold prices, but the drawback of this instrument is that it has no physical gold backing. So the sovereign gold bond is actually guaranteed by Government of India and is a liability of the government. Now, usually when people invest in gold, they prefer that their investment is backed by physical gold, and this is something that is lacking in sovereign gold bonds, and hence investors are not very comfortable with this product. Um, on the benefit side, the product does give an annual interest of 2.5% per annum, and capital gains are tax free at the end of 8 years. Another drawback of this product is the secondary market illiquidity, which means if you want to exit this investment before its maturity, that is before 8 years, you have to obviously sell it on the secondary market, which tends to be very illiquid, and hence prices trade at a discount ranging anywhere from 5 to 15%, which eats into your returns really, and in a way negates the interest, the 2.5% interest that the product actually is offering. So that's the sovereign gold bond. And moving on to the next slide, which is gold ETFs. Now, gold ETFs are investment instruments that are backed by 24 karat physical gold. These instruments are regulated by SEBI. There are no purity concerns. You can be assured of that. I will elaborate on why it is like that a little later. These ETFs, because they buy gold in bulk, they get the benefit of wholesale prices, which are then passed on to the investor, and hence results in higher returns for the investor. These ETFs units are listed on the exchange, and hence they're extremely liquid. You can enter, exit anytime you want, and there's no impact cost. There are, they always trade at fair prices on the exchange. And lastly, you get the benefit of GST credit here compared to traditional avenues, which like physical gold, where there is no GST credit received on sale of gold. So this 3% benefit that ETFs offer also translate into higher returns for the investor. So because ETFs require a demat account for investing, an extension of the gold ETF is the gold savings fund. So the gold savings fund essentially invests in the underlying gold ETF. So in this case, the quantum gold savings fund invests in the quantum gold ETF. It's a very efficient way to invest in gold. Like I said, there is price efficiency because we are buying gold at bulk prices and larger quantities, so we get better rates, which of course we pass on to you. There are no hassles of purity, storage, or insurance. So Quantum only buys 24 karat gold that is sourced only from LBMA accredited refiners. LBMA is the global authority on precious metals, and it has accredited certain refiners, and we only buy our gold from them. The gold that we buy is imported only through scheduled commercial banks registered with RBI to import gold. So purity is not a concern at all when investing with Quantum. The gold is stored in secured and professional vaults, and the gold is completely insured. It even includes terrorism insurance. Because ETFs and mutual funds are regulated, the underlying gold is regularly audited. Statutory audits as well as fund manager audits are done. And lastly, something that really sets Quantum apart from the other peers is that we undertake a purity test for all the gold bars regularly. to check the purity of the gold, and you will be pleased to know that all the gold held by the quantum gold ETF is 24 karat gold. So this is the first of its kind initiative in the industry, and really sets us apart from our peers. So lastly, we'll give you an action plan as to what you should be doing going forward. So for investors who already have an allocation of 10 to 15% to gold, just stay put and relax. Watch gold play a risk reducing, return enhancing role for your portfolio. Like we've discussed, there is tremendous potential going forward for the asset class. And for investors who are yet to allocate have not yet allocated 15% of their portfolio to gold, prices have fallen by 8% after touching all-time highs, and this is an excellent time to build your allocation. So what we would suggest is that you purchase 50% right now in lump sum to take benefit of the lower prices, and stagger the remaining 50% over the next 6 months to counter the volatility. So with that, we've come to the end of the presentation, and we can now take some questions. So let's get started with those. Yeah, Chirag, first question for you. How long is the bull rally in gold expected to continue for, and what level do you expect it to reach?
See, it will all depend on how the factors shape up, how the central banks react, how longer they'll keep rates lower. All will determine where, how much longer it's going to head higher. But at least given the current scenario, looks like 3 year looks like a good promising horizon where gold should kind of trend higher. So, it is difficult to pinpoint to what level or it will go. But the factors look constructive. We have seen the previous bull markets where gold had risen. Current factors look positive. So the trend overall, if you see over next 2 to 3 years, looks constructive. It is kind of increasingly likely that it may head higher.
All right. Could you please elaborate further on the US stimulus package and debasing of the dollar, and how this is going to impact gold prices?
Yeah, so the US will have to come out with some stimulus. So the spending is a given, right? The form of stimulus may differ from who wins the election, be it Trump or be it Biden. Uh, and the stimulus is going to be big. It could be somewhere around $2 to $3 trillion of stimulus that they will announce. So overall, the extent of stimulus is going to be pretty large. Uh, only thing is, see, if Trump comes, it will be more towards uh, uh, more towards building infrastructure. Even Biden will be somewhere similar to building infrastructure, but in some pockets, in the way it reaches the ground level, will kind of differ. But if both the stimulus is going to big, it is going to reach the ground level to the real economy in the hands of people, because that is the only way the economy will come out of doldrums. So overall spending has taken a hit. People, one thing to note is, despite such a large shock that the economy had, and despite so much loss of jobs, the personal income in the US has gone up. And that is largely because of the stimulus that the government did, the handouts that they gave in hands of people directly by sending them money into their accounts directly. So overall, that helped increase the aggregate income. Similarly, with the $2 to $3 trillion stimulus, the overall income of people will increase, and therefore when people get money in their hands, they're bound to go and spend, because many of them are hand to mouth kind of people. They don't have savings, they don't have jobs, so whatever money they get, they're going to spend it out for their living. And that is why when that spending happens, it's going to be inflationary. So overall, it will not remain in the financial system. It will trickle down to the real economy. And I think even the stimulus that we'll see very soon of $2 to $3 trillion or somewhere in that vicinity, it's not going to be the last one. we will continue to see more stimulus, more helping hand from the government to try and stimulate the economy to help it recover from the shock that we have seen.
Sure. Chirag, Indian import of gold is reduced by 57% this year. What are your views on that?
So I did touch upon that briefly. That if you see the Indian consumption is largely because of marriages. We have about 10 million marriages a year, and I don't think even we have seen a fraction of it happen this year because of the lockdowns that we have seen, because of the risk of the COVID spreading, and it was not allowed to an extent, a gathering of more than 20 people kind of thing, which was not allowed. So it's kind of not happened this year. Marriages have not taken place, which doesn't mean that marriages will not take place. We will see going forward, the postponement that has happened will again start as the lockdowns ease. So that big chunk of demand, which is nearly 600 tons of gold, has not taken place this year. But whenever it happens, we will see that demand spring back up. But if you see the investment demand has kind of offset whatever losses that we had seen on the physical demand side. It's kind of more than offset that loss. So that is why we've seen prices move higher. And I think that physical demand will come back sooner or later, and that will again help increase the overall demand for gold, because investment demand is kind of likely to stay over next few years. So we will see demand recover in India and China.
All right. Chirag, if the USD is down and gold is up, wouldn't that mean lesser net appreciation for INR gold?
uh, it's generally doesn't kind of work in that tandem. If the US dollar is weakening, it's not necessary that the rupee will appreciate in the similar fashion, in the same by the same extent, right? We have seen periods where dollar is appreciated vis-a-vis the global currencies. Usually, when we talk about the DXY dollar index, it is usually measured against the big global currencies like the euro, like the yen, those kind of currencies, like the pound. So the major components of the US dollar index are those currencies. So when US dollar is appreciating or depreciating, it could also mean that rupee could also depreciate in tandem, right? To that extent, there may be a little lesser pressure, but I think both can depreciate in tandem, which is very, very likely. If say the US kind of is weakening, and if the India growth doesn't recover the way people envisage, there could be exits of foreign investors out of India, and that could lead to depreciation in the rupee. So it's not. It's very, very possible that the dollar depreciates in terms of depreciating vis-a-vis the other global currencies, and rupee could also depreciate against the dollar.
Sure. Chirag, would it be the right strategy to get out of equity funds and switch to gold ETF if overall gold asset allocation is not at 15 to 20%? Or,
So
I'm sorry, there's a follow-up question. Or should the new investment, or should the investment be done through new investments to increase the allocation to 15 to 20%?
So it could be, I mean, whatever capital you have, be it invested capital or capital in your hand, is all one pool of holding that you have. So overall, we will say that given the circumstances that we are seeing, you need to have 12 to 36 months of cash with you, and post that anything that remains could be split 80-20, 80 into equities and 20 into gold. If you don't have that, you could very well rebalance the portfolio. Today is an opportunity where equity markets have run up, gold has corrected. So if you're not allocated to gold enough and more allocated towards equities, you could very well make that switch, right? And if you're already allocated to equities to the tune that you wanted, and you have enough cash in hand, then you could even allocate to gold and complete your 80-20 allocation. So there are two ways to go about it, right? One is to either see in a holistic way how your assets are divided, or if you think you have enough of equities and lesser of gold, then you can make that switch.
Sure. Chirag, what is your outlook on silver?
Silver, see, silver, if you see it, though it was as like gold, used as a form of currency in maybe 5,000 years back. But if you see silver, after getting de-linked as a form of currency, has most of its use come as an industrial metal. Around around 70% of the usage of silver comes as a industrial use. So silver will do well when your overall economies are doing well, when your economy is expanding, there is more demand for products. Uh, so that those times are when silver demand will also increase. So silver is known as like half copper, half gold, that gets pulled by both these metals, how they are doing. So, so silver is not very useful from a diversification perspective. So if you're looking from a portfolio allocation perspective, you could have some silver in your portfolio, maybe very small to the tune of your um, uh, uh, very small, less than 5% kind of allocations that you usually have for these kind of things, silver, platinum, those kind of things. But overall, it cannot be more. And whenever you have that allocation, you have to understand the demand supply dynamics, because that being an industrial commodity, that is what drives that. So silver demand going forward may kind of increase to an extent, because it's been used in like solar panels, like your laptops, like your mobile phones, those kind of things, where the demand has been increasing. But overall, I would not say from a portfolio perspective, you need to have an allocation to silver. Gold is better poised. Gold helps you during times when it counts. So have an allocation to gold, not to silver. And even if you have the allocation to silver, understand its demand supply dynamics, and then kind of invest there. So if you're going having a reflation trade, if commodities are going up, are going to go up, then you may have some allocation there. But overall, I will suggest you be with gold rather than silver.
All right. Chirag, one of our investors says that gold ETFs are not that liquid. Often we need to sell at market price, losing 1 to 2% during the transaction. Your
Uh,
comments on that?
See, usually we ensure that that you kind of put it at the market level, because that is what even we are tracking, and kind of try to ensure that it kind of reflects the fair value. So whenever you trying to buy or sell, don't put a market order. If you put at the right prices, uh, you will surely get you will surely get a buyer or a seller, depending on what you're trying to do. So if you are trying to sell, put it at the current market price, or maybe a rupee lower than the current market price that is prevailing, or that is you're seeing on the exchange, right? And even if that, because we have very good market makers who are quoting on both sides at all points in time. So I could at least say about the quantum gold ETF. And in case still you have an issue, please get in touch with us, contact your RM or anyone that you know. We will ensure that you get the second side of the trade, and that too at the fair price prevailing based on the current gold price, based on the current rupee rate. You will get the fair price. So in case, don't try to hit the market, don't try to put a market order, put a limit order at the prices which are close to the prevailing prices that are trading. And still, if you don't happen to get your trade done, please get in touch with us through an RM, and we will ensure that you get that trade executed at the right price.
All right. Thanks. So Chirag, have Russia, China, Turkey, and some other countries, started amassing gold instead of US dollars? Is this true?
So we have seen Russia, China, Turkey all been big buyers of gold. They have been accumulating gold over last few years, rather not very recent. China, they kind of don't report it on a regular basis, but there is good amount of speculation out there that they have been secretly buying a lot of gold. China again produces a lot of gold, so if they buy their own production, not many will come to know whether they are buying or not, right? So China has been trying to diversify. They have been buying assets other than in the US. They have been accumulating a lot of gold. Russia has been buying a lot of gold. Turkey has been buying a lot of gold. So yes, as we have shown in one of the charts, many of these countries are reducing their reliance on dollar and are moving into assets like gold. So yes, to an extent, I will agree with that statement.
All right. Uh, Chirag, are you not considering rupee appreciation scenario at all? The USD INR range used in the slides was between 75 to 85.
So that was just, I mean, if you see over a period of time, rupee has depreciated. We don't see any reason why that will change, right? People cite that we have very high forex reserves now, and therefore rupee should appreciate and not depreciate. But we have been building those reserves over a period of time, right? And rupee has depreciated all this while. So we don't see that as a good enough reason why the rupee should appreciate and not depreciate. We think that the depreciation will continue. Uh, we still have, we still run, the current account deficit, of course, has improved a bit. But if you see forex reserves as a percentage of import cover is still around the same levels that we usually have, 9 to 11 months of import cover. Sometimes it has reduced in kind of times of crisis, like it's gone down to 6 7 months, but it's usually is in that range. So there is no not much if you see on a relative basis that forex reserves is not as big as any other time historically, maybe slightly higher, but overall, we don't see any reason why that trend of that depreciation that we have seen all these many years is changing. We don't see that reason, enough reason for that. Therefore, we think that rupee will continue to depreciate whenever the economic recovers. Our imports of gold, oil, all that will also increase in tandem, and therefore again the current account surplus position that we had seen may kind of change into a deficit situation also going forward. On the fiscal side, we also have issues. We are running deficits. If the economy has to recover, there will be kind of some support. Like if you see this year, the fiscal deficit, because of the lower revenues for the government, has increased also. We are reliant on foreign capital uh, in terms of FDI, FII, remittances. So that's not changed much. So overall, on a secular basis, uh, we don't see a trend that there could be small bouts of rupee appreciation, but we think over a long period of time, maybe over a few 5 10 years, we will still see the same trend. The extent of depreciation may kind of come down a bit, like what we had seen about 4 5% depreciation may come to say a kind of 3% depreciation, but we will still see continue the depreciation trend that we have seen all these years.
Sure. Chirag, what are your views on the sovereign gold bonds? And if an investor is planning to hold them till maturity, wouldn't that be better than gold ETFs?
So mathematically, from a return perspective, right, it is beneficial than any other asset that you get, because it gives you interest and it is capital, it is tax free. So that being apart, uh, are you comfortable holding a gold instrument which is not backed by gold, right? People kind of invest in gold because one of the important characteristics of gold is that it is an asset and it is no one else's liability, right? When you are buying the sovereign gold bond, you're changing the characteristics of gold from being no one else's liability to though it is sovereign, but it's still a liability of the government, right? So not many investors are kind of comfortable with that notion that you're changing that characteristics. So not being backed by gold is one of the important impediments for the sovereign gold bond. And secondly, in case say if gold prices increase significantly and you want to sell it, Sovereign gold bonds have tended to trade at a discount. So whenever you have to kind of exit, if you're not comfortable with the price, it's gone up significantly higher, and you want to exit, you will have to take a very big discount. And there is a reason for being getting that trading at a discount, right? Because given that it is not fungible, say a market maker quotes you for that sovereign gold bond. So whenever they have to quote you, they will see that I have a lock-in in this bond for, like, say 1 year, 2 year, 3 year, 5 year, whatever period that be. And for that period, I have my hedging cost because I don't want to take a risk on gold prices, and I have my liquidity cost. Liquidity cost for a market maker is somewhere around 6, 7, 8%, and their hedging cost is around 4 or 5%. So if you see their total cost on a per annum basis is about 10 to 12% at least, right? So whenever I as a market maker have to quote, I will ensure that I keep that margin so that I don't run into losses, right? So that is the reason why the sovereign gold bond trades at a discount. And whenever there is a lot of sellers out there, the discount may increase, right? So those two things together, not having a gold backing, and second is liquidity issues, is kind of the driving. So if you say if you have to sell at a discount, like the maximum discounts that we've seen usually has been around 10, 12, 10, 15%. Say if you get a 2.5% interest, right? So 2.5% over 5 years will be over 4 years will be say 10%. And if you have to lose that as a liquidity discount, then what is the incremental return that you have made, right? So all these factors combined, I think still there are people who believe that it has to be backed by gold, and believe that it has to be liquid instruments, and therefore prefer gold ETFs or sovereign gold bonds as well. But from a return perspective, I will completely agree that sovereign gold bond has a higher return, but these are the drawbacks when you tend to invest in the sovereign gold bond.
Sure. Chirag, all gold ETFs represent 1 gram of gold. So, why do their prices vary so substantially, and how can an efficient gold ETF be identified?
Yeah, that's a very good question, I think. Yeah. So overall, if you see, there are various gold ETFs, about 10, 11 gold ETFs out there. And uh, if you see, many have changed over a period of time their denomination, they are representing. So no longer, there are hardly any gold ETFs that represent half 1 gram of gold. There are many, like there is quantum gold ETF, which is half gram of gold. And there are many others who have gone like 1/100th of a gram of gold, or 1/10th of a gram of gold. So everyone is at a different denomination, right? Firstly, secondly, there is a kind of difference in terms of the years through which when they were launched. Some were launched in 2007, some were launched in 2008, some or 10, 11, those kind of years. So if you see, there is an expense ratio for the gold ETF. So the difference between the gold price and that ETF price is generally the accrual or expense ratio, right? So if a fund has completed 1 year, it will just have a 1 year of expense accrual. If a fund has completed 5 years, that fund will have 5 years of expense accrual. So so there will be a difference because of the different expense accrual that we have seen, right? Say if the expense ratio of a fund is say 0.5%, so over 2 years, that fund would be lower by gold than the gold price by 1%. And the same fund, if say it has completed 4 years, then that fund will be 2% lower than the gold price, right? So that is why different ETFs were launched at different times, and therefore have different expense accrual periods, and therefore they trade at different levels as compared to the gold price. So that is the main reason behind. So why the funds are trading at different prices. One is because of different denominations, and second is because of the extent of amount of time that those fund houses have seen, because when they were launched were different time periods. How do you identify a better gold ETF, right? One, is look at their tracking error. Everyone publishes their tracking error. Lower the tracking error, better the fund is, right? Everyone in their fact sheets uh, print their tracking error. Second, everyone has gold as the underlying instrument for the ETF, right? And this underlying, what are the practices that the fund house follows? What are they doing over and above to safeguard the gold that they have? Well, so we have to take into consideration those policies. Like for quantum gold ETF, is only fund out there who also does a purity test of the gold that they hold, right? So we are not only relying on audits, we going and checking the gold bars, we kind of insuring it completely, uh, have policies on what kind of gold we own. It's also trying to ensure that the gold that we hold on account of investors, because it is our fiduciary duty to do that, that the gold is indeed pure. So we have been for years doing that purity test of all the gold bars that we hold on behalf of investors. So that is one important trait that you need to see what kind of safeguard that the fund house has, so that the gold is indeed gold and you don't have surprises. So this is very, very important. And thirdly, in terms of the guidance, does the fund house help you in terms of taking or understanding the gold market well or not? Are they helping you with your queries in terms of understanding where is gold headed, how it is, how do you allocate? So these are the three important areas which you need to look out for to identify which fund house or which gold ETF you should invest into.
Sure. Chirag, is it really worth to enter at these levels, even though prices have corrected? Should one wait for further correction in prices?
So I think we've already seen some correction from the top by about 10%. Uh, I could recollect in a few years back kind of scenario where gold was at 15,000 rupees. People were telling me it's already doubled. Should we invest now? Uh, and we see a few years later, it even doubled from that 15,000 level to 30,000 level, right? So similarly, think I feel when people ask me that question today, gold prices are already gone up from 30,000 to 50,000. Has it peaked or is there more room to go? The best determinant is to see what kind of factors are shaping up in the external world and therefore tell you the prospects. Don't go on the price level that you aren't you investing in, weren't you investing in equities when Nifty was say about 12,000? It was an all-time high at that time, right? Similarly is gold. Gold is also an asset which is determined by the fundamental factors prevailing out there. Gold at the end of the day is a monetary asset, and long-term trends in money will determine where gold is headed. And all those factors seem to be positive for gold today. So I think gold is already corrected from 57,000 rupees to about 51,000 rupees today. So I think it's still it's utilize this opportunity as we have shown in our action plan. If you don't have a 10 to 15% allocation to gold, please buy some gold today. To the extent you don't have the allocation, buy 50% of that. So if you are say wanting a 15% allocation, you only have 5% allocation. Buy another 5% now, and the rest 5% you can split it over next 6 months. So that is how you could build your allocation. But yes, please don't go by the prices. Look what factors are shaping up and act based on that. uh, uh, Price level in itself is no determinant of where the asset is headed, but allocate to gold. Ensure these uncertain times you have a 10 to 15% allocation to gold.
Sure. Chirag, can currencies other than the dollar, like the euro, have an impact on gold prices?
So, yes, depending on what policies the euro has by their governments and by their central banks, could have, because depreciating euro, if the euro is weaker, that will tend to help the dollar and therefore also have impact on gold, right? So it's all very very related. It will also depend on if euro has a policy of debasing the euro, which will mean a lot of people in Europe will tend to go towards gold kind of assets. So that also has an impact on gold. So yes, most of the currencies today, as I've said previously, that gold at the end of the day is a monetary asset. Long-term trends are determined in gold are determined by what happens on the monetary front, right? So be it any currency, it will tend to have some or the other impact on gold.
Sure. Chirag, can you elaborate on the GST credit of gold ETF investments?
Sure. Uh, See, whenever you buy gold or we buy gold for the fund, we pay GST, right? Today, 3% is the GST rate. So if gold is say 100 rupees, you have to pay 3 rupees as GST. So whenever you buy gold, you pay to the seller of the gold that 3 rupees as GST or 3% as GST, right? And whenever you sell your gold, right? You as a retail investor or any other investor buying or selling physical gold, given that you are not GST registered, you will lose out on that GST. So when you buy, you pay that 3% as GST. When you sell, you don't get that GST back. So there is a net loss of 3% when you buy and sell physical gold or be it digital gold, right? Uh, when you buy and sell a ETF in through an ETF form, given that at the back end when we buy gold, we pay 3% as GST. But given that we are GST registered, when we sell gold, we collect GST, but we get an offset. We do not pay it back to the government to the extent we have a credit, because whenever we bought gold, we have paid. Whenever we sell, we have recovered, but we need not, we can offset it against the buy GST that we have already paid. So we as mutual funds being passed through vehicles will pass on that GST benefit that we get to the investors in the gold funds, right? So you don't lose out on GST when you buy through an ETF form, but when you buy it through a physical form, be it a physical gold or be it digital gold, you lose out directly that 3% on GST. With gold ETFs, we give you that pass back or that offset benefit, and so that you don't lose out on that GST that you pay at the time of buying.
All right, thanks, Chirag. One last question to end the Q&A on a festive note. How do you think Diwali will impact gold prices in India?
So I think Diwali, I think anticipate further buying of gold in India. Uh, One is there is some pent up demand out there. Second, monsoons have been good. So whenever the monsoon is good, you get a good harvest, and a lot of gold is bought in rural areas. So we anticipate good buying from rural areas. Uh, Third, with easing of lockdowns, we are hearing that uh, the marriages that were postponed will kind of start going forward. Uh, November, December, January being peak seasons for marriages, I think that will also catch up. And the buying for that will also, because no marriage in India is complete without buying of gold. So we will anticipate further buying on account of those marriages. So overall, we anticipate increased buying from Diwali onwards, or from Dasera onwards rather, till the end of the year. So whatever decline in buying that we had seen or all these years because of COVID, all these months because of COVID, will kind of catch up going forward. So as I've said, the Indian buying has only got delayed and it's not cancelled. So we anticipate good buying going forward, and that would also be a helping hand to the gold demand overall, and it will not be just alone the investment demand to pull prices higher. But overall, whenever you're investing in gold, physical demand that we see usually acts as a floor to prices, and the investment demand is what is kind of driving the prices. And all the factors that we see for the investment demand are very much positive. We anticipate incremental investment demand to come. and therefore we are having this positive view on gold prices. So I hope that explains the physical buying that we anticipate going forward.
That's wonderful. Thank you, Chirag, for sharing those insights and for patiently answering all the questions. We've taken care of almost all questions on the Q&A. So we hope we have assured investors that given the macroeconomic fundamentals are stacked in favor for gold, you have more than enough reason to remain calm and confident, and gold will continue to play a risk-reducing, return-enhancing role for your portfolio. On that note, we will conclude the webinar now. Thanks everyone for joining. Thank you, Chirag.
Thank you all. Stay safe and please invest in gold.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.